Welcome everybody to part 2, how to account for a fair value hedge. This is a continuation of part 1. If you haven't yet checked out Forex part 1 of the video, please do so before proceeding further. Before we continue, a recap of what we covered in part 1. So in terms of the question, we had a finance lease agreement with a foreign supplier for which payments were made in euros. The question required us to draft journal entries for the year ended 28 February 2012. We also computed and captured our spot and average exchange rates on a timeline, and we calculated the variables required for our amortization table, and we computed the data within it with this information. A new point that needs to be taken into account for this video is the fact that the hedge meets all the qualifying criteria for hedge accounting in terms of IFRS 9. You are to assume that the hedge is 100% effective for the entire duration of the hedge. Remember people, the reason why the question is providing you with this fact over here is to point you to the fact that it's giving you permission to perform hedge accounting. In terms of the step-by-step process which we mentioned in the previous video, we will now read the question. Due to the weakening of the rand, the company decided on 1 September 2011 to hedge itself against any further foreign exchange losses. The company entered into a 6-month forward exchange contract on 1 September 2011 at a forward rate of 10.15 in order to hedge all remaining installments. On 28 Feb 2012, after the second installment was paid, the FEC was renewed for another 6 months at a forward rate of 10.20 in respect of the outstanding installments. The company designated the FEC as the hedging instrument, and the hedged risk is changes in the cash flow of the payment of the interest portion of the installments and the changes in the fair value of the payment of the capital portion of the installments. So this is a very important point over here because it's essentially what today's video is all about with regards to calculating a fair value hedge. And remember, once again, the next step to this process is for us to capture our FEC rates based on the data that the question gives you. The next step is to draft out your response. In terms of the FEC rates that the question provided us with, we now have to basically understand specifically which balance it is that we are analyzing. And that balance would be, as at 31 August 2011, 84,924. Because at that date, your remaining capital is 84,924 euros. Between 31 August and 28 February, we'd like to analyze what the movement in our FEC is from one point in time to another. The relevant rate that you need to take at 31 August is 10.15, which is your FEC rate. And at year end, you will take your spot rate. You will then multiply those two in order for you to translate your FEC asset into ZAR. And as you can see, your FEC asset balance is decreasing. There's a movement of 5945 ZAR between the two dates. You could do it this long way, or you could simply opt to arrive at this value in a linear format as shown. Once you have this value, you can then simply capture or post your journal entries. And since your asset is getting smaller, you have to actually credit FEC asset or liability. You can classify it in whichever way you'd like, just as long as the direction of your journal is correct. And in brackets, you will write financial position to show that this is an account that goes on your statement of financial position. The contra entry will be your fair value adjustment of 5945 that goes to profit or loss. I hope that you have found this video useful. Click like and subscribe for more. If you have any topic suggestions in the field of financial accounting, MANAC, or auditing, feel free to comment on this video and let us know. Thank you very much.